Well, hello everybody. This is Ron Wheeler, and it's my pleasure to bring you tonight's special presentation, The Necessary Balance of Being a Successful Income Investor. Now, at VectorVest, we've been talking about income investing for a long time now, but what we want to talk about a little bit tonight is how to achieve that necessary balance of choosing a high probability strategy, a strategy that prioritizes capital preservation. Because the enemy of any income investor is when you lose more than you win. So it doesn't matter how right you are. You can be right 80% of the time, and we're going to talk about this tonight. But even if you're right 80% of the time, you can still lose money. So income investing really is one of the easiest things that you can do, as long as you understand and embrace that delicate balance. So let's talk a little bit about that tonight. So just a quick review again, what actually is income trading? Income trading is a high probability strategy. That means we want to be right more than 50% of the time, and not because we're getting an indicator correctly or we're analyzing the stock right. It's more about we're setting up a trade that allows us to be statistically greater than 50% right. And while we're doing that, we also want to preserve our capital. That means if I'm 60% right with my trades, it's no good if I'm losing $1,000 for every $100 I receive. It's not going to work that way. That's that delicate balance that we refer to. So to kind of put it into simplistic terms, we want trades that allow us to win even if our underlying direction on the stock or the market, whatever we're trading, is incorrect. So if you're bullish, I want to be profitable even if the stock or the market doesn't go up. And if we're bearish, I want to be profitable even if the stock or the market doesn't go down. And I say market because we can do this on indexes like the S&P or the NASDAQ or the Dow or the Russell or individual stocks. It really doesn't make a difference. So what kind of income trades are there? Well, stocks with dividends is a way of income trading, right? You buy a stock, whether the stock goes up or the stock goes down, you can get paid a dividend. That's great. Now, unfortunately, if the stock goes down and you lose that capital appreciation, right, the dividend's not going to offset that, but at least it pays you some income. Covered calls. You own a stock, you sell a call against it. Not only does it allow you to collect some income from selling the call, it also kind of gives you a little bit of hedge to be wrong. You don't have to be right to make money. I'll actually demonstrate that here this evening. And then we have option-only trades. And that's when the light bulbs go off for me. That's my specialty, right? I'm going to do this with option-only trades. And the reason why I love option-only trades is because they're very easy to do. They're intensely risk-controlled. And they don't require a lot of money to get started. That's the beauty of this. Anybody can do these types of trades. So this again is where that delicate balance comes in. We want to balance these components of the trade. We want to balance probability. We want to make sure that we're going to be right more than 50% of the time statistically. And we want to make sure that when we have a losing trade, we're not risking 10 of our winners on every trade. We want to make sure that we're risking an equal amount of money on our gains. So let's talk a little bit more about how to do that. Now, what you see in front of you, this is a risk graph. Now, don't be intimidated by a risk graph. It's not important that you know every single little thing about this tonight, but this is a risk graph, but this is very easy. All this is a stock. I'm essentially showing you the profits and losses if you were to buy 100 shares of IBM. Now, this is where the stock is at right now. And you'll see that little dotted line kind of moving around, but that's where the stock is, right where that blue arrow I just put in there is. Now, in a risk graph, it's pretty simple. If the stock goes up, you're going to make money. And let's go ahead and just simulate this. I'm going to click up here and say, I'm going to buy 100 shares at the last price of $276.64. Now, you're going to see another line pop up on the screen now. Over here on the right, you're going to see this. That means I'm up $3 right now in this position. And you'll see that number increase or decrease based on the stock's price. If the stock were to go up, let's say it goes up to $279 right here, this risk graph will show that I would be up approximately $239 on the trade. If the stock were to go down to $274, okay, it would show, and I guess I should point the arrow down, not that it's a big deal, I would be down on the trade right here of $263. So that's all the risk graph shows you. It just shows you what your gain or loss on a position if the stock goes up or the stock goes down. Now, notice one thing about this position. It's binary, if you will, right? It's two choices. It's on, off, 0, 1. The only way I make money is if the stock goes up. Now, apparently I must have bought it at a right point, right, as a simulated position, but it's already up $26 a share, or not $26 a share. It's up $26, right? That's great. It must be up a little bit from where I bought it. Great. But again, it only goes to profits if the stock goes up. If the stock goes down, there are no profits to be made. This is not what I would consider an income trade. Now, income trading, for me, always starts with selling an option, okay? Now, when you own a stock like this, it's really, really easy, right? If I go out there, and again, you don't have to worry about the nuts and bolts of what I'm doing with the risk graph, but let's say I go out there and I add an option like to this. I'm going to do a covered call. I'm going to sell 1, and I'll go out to November for this. And let's say we sell a 285 option. Why 285? Why not? I just selected. This is not really about, maximizing your covered calls. I'm just showing you an example of how income trading works. I'm going to go ahead and add that to my risk graph. I'll click OK. All right. Here's what that did to the trade. Now, take a look, and the risk graph looks a little bit different now. This is the current price of the stock, right where that vertical dotted line is, right? Now, here's what can happen. If the stock goes up, you're still going to make money. The profits are over here on the right-hand side. If the stock goes down, you're still going to lose money at first. But with options involved, options have something called time decay or theta. What happens is, and I'm going to show you this next, if this option, let's say the stock doesn't go anywhere, it stays right where it is for the next 30 days. As you get closer to expiration, I want you to kind of keep focused where that blue arrow is. As time continues to come in, watch what happens. You're going to start making money based on the option that you sold decreasing in value. Okay? Now here we are at the beginning of November. If the stock stays perfectly right where it is, you would be up on that trade about $363. You are making money even if the stock stays sideways. Now, what you're also seeing, look at this. This is where that new dotted line crosses 0, right back here at around 271. So now on November 1st, today's October 17th, on November 1st, as long as the stock stays above that price right there, you are going to still make money. So now the stock is going down and you're still making money. That's the idea of an income trade, right? If the stock goes up, great, you make money. If the stock goes sideways, great, you still make money. If the stock goes down, now you still have the opportunity to make money. And if you own stocks and you're not doing covered calls, you should really look into that. We have a covered call boot camp you should look into. It's a great thing to do. But the problem with covered calls, and it's not really a problem depending on your capital, they are expensive. This trade right here, I have to buy 100 shares of IBM. That's $28,000. Let's make this a little bit more simple if we think IBM is going to go up. So I'm going to start, instead of buying the stock, we're actually going to sell an option. So let's talk about that. IBM. I want to sell an option on IBM. So I'm going to stay in Options Pro. Now, I want to assure you that most brokers out there have this information as well. I'm going to go to an option chain, and I'm going to go to IBM, and I'm going to go out to November. I like to keep my options between 21 and 45 days to expiration because that's where you're going to really capitalize on that time decay I just showed you. So we're going to go out to November, 35 days away, IBM. Now, again, I'm not saying that IBM is a great trade. I'm just using this as an example. IBM works. Now, let's talk about probability. What we want to do is we want to sell an option that has a high percentage of finishing out of the money. Now, if you don't understand all this right now, it's okay. This is just a beginner lesson and we can go much deeper into this. But I'm going to look at my puts and I'm going to sell a put on IBM that gives me greater than a 60% chance of making money. Now, how do I know that? In Options Pro, there is what's called the ITM, the chance of that option going in the money. And I'll explain that here in a second. But what I'm looking for is I'm looking for that chance to be less than 40%. So that 270 option has a 38% chance of going in the money. So just to kind of give you an idea of what that means, if an option goes in the money, we lose. So we have a 38% chance of losing if we sell this option. That means we have a 62% chance of winning. So let's take a look at this. I want to explain how this works. Now, when I put the risk graph back up on the screen, you're going to notice that the risk graph looks exactly like the covered call. I'm going to go ahead and tell Options Pro I want to sell that 270 option. I'm going to go ahead and put that on the risk graph. And here's what it looks like. Let me get rid of those because those aren't important for right now. You'll notice that risk graph looks very, very similar to the covered call. Now, if the stock goes up, that's that dotted line right here, you're going to make money. If the stock goes down, you're going to start losing money. Okay? Now, right away, we have a greater than 50% statistical chance of making money. And remember, the way this works is we make money fast if the stock goes up. We make money slower if the stock kind of stalls. We make money a little bit slower if the stock goes down a little bit. Because remember, when you sell an option, this is the key here, right? You make money as that option loses its value. If you've ever shorted a stock before, right? You sell a stock at $100, you buy it back at 95, you made $5. Selling an option is very similar. We're going to sell this option. Right now, it's trading for $10.23, right? Well, if the stock moves up, that option value is going to decline, and you're going to exit that trade later on for less money. You're going to open the trade by getting paid $1,000 in this case. We're going to later on close the trade, hopefully by, exiting it for $600 or $700 and keeping the difference. That's how an option sell works. Okay. So now let's say, and again, I'm going to use the risk graph here. Don't be intimidated by the risk graph, please. It's something that takes a little bit of time to get used to, I promise, but it really is easy. This is where the stock is at right now. And I'll make that, again, make it a little bit bigger in blue so it's easier to see. There we go. All right. Now, if the stock goes up, we win. If I move this, and watch how that additional dotted line comes in, I'm going to move the dotted line to where it is November 1st. So about 2 weeks, right, from today, November 1st. And if you look in the lower left-hand corner, that's where I'm moving that. That dashed line or that little dotted line that appeared, in 2 weeks, if the stock stays exactly where we are right now, you're going to make $305 on this trade. How do you make the $305? Well, the premium of that option is going to decline from $10 down to about $7. You're going to be $300 in profit. You open the trade at $10.25. You're going to be closing the trade essentially at $7.25. You'll be up $300 in the trade. Now, also look what it does. As long as that point, the stock is above 270, you are going to be profitable on that. And as we get closer and closer to expiration, you're going to see that no matter what, even if the stock stays sideways or if it goes down a little bit, you're still going to be profitable on that trade. That's how you put probability in your corner. We sell options that have a less than 40% chance of finishing in the money. And what is in the money? In the money simply means that the price of the stock, right now it's $277, would surpass the price of your put of $270. So as long as the stock stays above $270, it is out of the money. If it falls below $270, that means the option goes in the money. That's all that means. Okay? Our goal is we're going to be selling out of the money options to stay out of the money. We don't want them to go in the money. We'll talk about that here in a few seconds. Now, the second component of this trade, I want you to take a look over to the right. This is the breakdown. The breakdown of that trade is you can make $1,000 if we're ultimately correct. How would we make $1,000? We would make $1,000 is as of November 21st if the stock stays above 270. And that's what you see. And I'm going to take these two lines off the screen real quick. That's what this solid blue line means. This is how much money the option trade would pay you on the day of expiration. So if you let this trade expire, which by the way, we never do, but if you did on November 21st, that option that you were able to sell for $10.38, $1,038, would expire with no value and you would make $1,000 on the trade. That's what happens at expiration. Now, if you did this and you let the trade expire, and let's say we were in the money, that means the stock is lower than 270, you are going to be put to the position. You would now own 100 shares of IBM at $270 a share minus whatever the premium was. But that's not what we're talking about here. We're not ever going to do that. We're never going to own the stock. We're never going to take possession of it. We're never going to let these options go to expiration. But that's kind of how that works. Now, where's that big risk come in? Well, theoretically, right, the stock could go all the way to zero. And if the stock went to zero, you would lose $25,000 on that trade. Well, that's a lot of money to put out. It's expensive to sell options, what's called naked, without any protection. And it's also a lot of times involves a lot of risk. So what we're going to do is we're now going to shift into that second part of the balance of capital preservation. So with capital preservation, the first thing I want to do is I want to knock this trade down from a risk perspective, okay? So how I do that is I sell that option, but now I'm going to insure it. And the insurance really comes down to this, right? When you sell a put, you may be obligated to buy the stock. Now, I've been doing option selling like this for 15 plus years. I've never actually had to do this, but it doesn't matter. That's what you have to do if called upon. You may have to buy the stock. So what I'm going to do, I'm going to go out there and hedge it. How do I hedge it? I'm going to go out there and I am going to buy a put a little bit lower. So I'm selling a 270. Now I'm just going to go out $5 lower and buy a 265. Now, when I do that, I want you to think of this in terms of risk management first. I want to talk about the worst case scenario. Let's say that something tragic happens to IBM. All of a sudden, the stock goes to $50 a share overnight, right? It can happen. It's very unlikely, but it can happen, right? Well, let's say that you are forced to buy IBM at $270 a share. That's what happens when you sell a put. But when you buy the put, you now have the right to sell it for $265. So you may have to be forced to buy it at $270, but now you can turn right around and sell it to somebody else for $265. Even if the stock's at $50 a share, it doesn't matter. The most you're going to lose in that trade is $5. Now, you lose the $5 because $270 and $265, but you also have to balance the option premium that you did. When you do this transaction, you're going to receive $10.40 times 100, but you're going to spend $8.40. You're going to have a net proceed of that trade for $2. You're going to get paid $2 when you place this trade. That's called a credit spread. Okay, so $2. Now that $2, that gets removed ultimately from the risk. So you had a $5 risk minus that $2. Your maximum risk on this trade is $3. Okay, so right off the bat, what you've done is you've minimized your risk. You're doing risk control. Now, if you look over here to the right-hand side, you're going to see the maximum risk on the trade is $300. The maximum profit is now $200. Okay. Now, that may sound different to you. If you've never done this before, wow, I'm making less money than I'm risking. This is probability trading. It's a little bit different than just buying low and selling high. Now you've got probability in your corner. Remember, there is only a 38% chance of $300 happening, but there is a 62% chance of $200 happening. So let's lay that out. And this is basically the math that I would urge you to do when you look at opportunities like this. So there's a $300 loss that can happen 32% of the time, and there's a $200 gain that can happen 68% of the time. So let's extrapolate that out over 100 trades. So what do we got? We got $300 loss times 32 trades, $9,600 loss, but that $200 gain times 68 is a $13,600 gain. So in that particular scenario, you would make $4,000 over the 100 trades. So that right there is a profitable scenario. Now, the one downside to that is you're keeping this trade to expiration. So when you hold the trade to expiration, and if the trade expires fully out of the money, that means it goes lower than 265, you'll generally just be assigned the loss. You would take your $200 loss in this case, and you would kind of move on with your life and be done with the trade. So we don't want to keep these trades to expiration because back testing has shown that getting out of these trades early actually, and I should say this, not only exiting the trade early with a gain, but exiting the trade early with a loss allows you to make more money. So let me show you how we manage these trades, and we can kind of still extrapolate that math. So the first thing that we're going to do is we're going to take profits at 50% of the premium received. So when we place the trade, if you remember, we received $200. We're going to exit when we make 100. And as long as the stock goes up, we can make money. Now remember, as time comes in, let's go ahead and move that to November 1st again. You can kind of see how that trade progresses. You're still going to be up on the trade as long as the stock stays in that green section. And the green section I'm talking to is essentially above that $270 price right there. So as long as the stock stays above 270, time is on your side, and eventually with time decay, you're going to make money on that trade, as you can see. But what we're going to do, we're going to limit our risk on this trade by exiting if the trade were to fall below 270. Remember, we talked about we're going to stay in the option if it's out of the money. If it goes in the money, we're gone. If that happens, you are going to lose this amount right here. Right where I'm pointing my arrow, if you look over to the right, that's $42. So if we exit at 270, we lose $42. Okay? That is risk control. We're only going to lose about $42. Okay? Now, that risk, by the way, gets usually lower as the trade progresses. If we're in this trade November 1st, the risk actually decreases to about $33. Now, by the way, this trade, you could place this trade with a $500 trading account. That's it. That's all you really need. But let's extrapolate those new numbers a little bit. So remember, you're going to have a $42 loss 32% of the time, and now a $100 gain. So the numbers are all going down, but that's going to be 68% of the time. So doing the math, that means we are going to see on the loss side a $1,344 loss over 100 trades. On the gain, we're going to see a $6,800 gain. So we're going to see a $5,456 gain over 100 trades. So think about that. If you keep the trades to expiration, this is one of the things that really throws off a lot of folks. You think, well, Ron, if I keep the trades to expiration, I'm going to make more money. That's correct. But if you keep it to expiration on the other side, you're going to lose a little bit more. We're getting less profits, but we're managing the trade to a lot less losses. You can see there's a big difference. $4,000 gain versus a $5,400 gain if you manage the trade like we talked about. And the key here is you're keeping that risk under control. That's really what it's all about. You've got to keep that risk under control. Now, I want to share with you some of the results that I've done this year with my Ultimate Retirement Solution coaching. So I take a two-prong approach to my trading. I do some stocks, I do some SPX, and my goal is to try to make around 3% per month. This is my results so far for the year for stocks. I've placed 63 winning trades. I had 45 losers with an average win of about 58%. So out of all those trades, I've won 58% of them. So not quite 60%, but I'm close. My accuracy is a little bit low this year. But what I also want to show you is my average win versus my average loss. $743 average win, a $732 average loss per trade. And I've placed about 110 stock trades this year to get that. So you can see that not only did the numbers extrapolate well, also the concept of the trade in real life extrapolates as well. So this is just my stock performance for the year. So that's only half of what I do, but I wanted to show you the big numbers there of 100 trades, and you can kind of see how they extrapolate into real life. Now, to do this, you'd have to have about an $80,000 trading account. I base it on $100,000, so it's still about a 14% return for the year so far. And again, that's half of the trades I do. I'm also up around 9% on the S&P 500 this year, which I also trade as well. But I just wanted to show you again how those numbers extrapolate. That's the beauty of a good income system. Not only should it work the math, but it should work in a practical application. Now, if this type of trading interests you, we are getting ready to launch our Options Paycheck Experience, and this is the most comprehensive program for learning this type of income trading there is. We're going to teach you how to find the trades, set them up properly, manage them, just like I showed you tonight, except we're going to expand it out to the full package. Now, if you're interested in some more information about the Options Paycheck Experience, the first thing I would do is urge you, if you are interested but you're not quite ready to join, take a look this week. We've got 2 classes coming up on October 20th and 21st. These are our introduction classes, how to generate 3% per month with 1 option trade per week. This is where we're going to dive a little bit deeper into it as well. So if you're interested but you're still not there, kind of come with us. Keep an open mind and take a look at what we do for income. But the Options Paycheck Experience is an 8-module course. We're going to teach you from all the way at the beginning to just learning options to the execution phase where we're showing you how your broker works and how you can put these trades on. As with all the courses here at VectorVest, we offer a 100% money back guarantee. So if you decide that you want to take the Options Paycheck Experience, but you don't think it taught you how to create income, we will give you your money back. All you have to do is let us know within a week of finishing the course that you didn't like it, you didn't think it works. We'll be happy to give you your money back. All we ask is that you do the assignments. You come to the class, give it a chance. Keep an open mind because we know if you do the work, you will see the results. We also offer a couple of bonuses. We're going to give you our mastery package. You're going to watch the modules on your own. Then 3 times a week through Q&As and mastery, we're going to teach you and we're going to overwrite the key principles. We're going to do assignments with you. You have opportunities to ask me questions. This is your way of attending a live presentation and getting all of your questions answered. If you don't have access to Options Pro, we'll give you a trial for that through November and mid-December, along with the live course. That way you can test drive our products for that. And again, that's one of the bonuses. In December, we're also going to teach you how to do this with live trading. So we're going to learn it in November. We are going to implement it in December. You're going to be invited to our coaching events where I showed you those results earlier. That's where I got those results in that coaching class. And again, you'll be able to follow along the trades with me. A lot of our clients say this is like the most favorite thing of the class because they got to see it happen over and over with real trades, implementing it right from the start. We also offer our SPX Paycheck class. I showed you the results, up about 13% from my stock trades. I'm up around 8 or 9% from my SPX trades. This is 1 trade a week that we teach you. If it's something that you're interested in and want just getting started, you can do this on, again, 15 minutes a week. 1 trade on the SPX. It's got 1 setup rule, 1 profit taking rule. It's a really easy trade to do. A lot of our clients start with this and then expand out to the full paycheck. So I do want to offer you kind of a special. If you are interested in signing up right now, just go to optionspaycheck.com. It's $9.95. We'll hold that price for Monday at 6 p.m., October 20th. That's Eastern time, by the way, for $9.95. It's the lowest price that you will access the class for unless you've taken it before. We do have a special alumni refresher. You can always give the office a call and sign up for that. But optionspaycheck.com. And again, this is something we've been doing here at VectorVest for the last decade. It's been very successful. It's something we implement every single week in our trades. And it's something that everyone should do in their portfolio. Finish off 2025 strong. Learn how to be a proficient income trader. Get 2026 as your first year of providing good income to you. Thank you for attending tonight's presentation. I appreciate it and wish you all of the best in the future. I hope to see you for our next Options Paycheck class. Thanks again, everybody.